Hey, what's up guys? John here. Do you want to invest in real estate? Are you concerned about a market crash? Well, there's some very, very big things happening in big cities all around America. And I think what we're going to start to see is a wave of foreclosures and defaults way bigger than 2008. I mean, this is going to be absolutely massive, and it's going to impact nearly every single business owner, operator, landlord. This is going to be huge. And I've been talking about this for quite some time, and now it's slowly starting to happen. And some of the biggest landlords in America are starting to go into foreclosure. I'm talking billions and billions and billions of dollars in loans. They just simply can't make do on these payments, and it's going to get worse. Here's what's happening. It's so crucial that you know this. If you live in a big city, so you can prepare for what's happening. I think there's going to be a big chance to make a lot of money over the next 5-7 years. But I think that there's going to be this wealth transfer, and then you want to position yourself for it. I'm going to kind of lay out what's happening with facts and evidence, and I'll leave all of the links pinned to the show notes of the video. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's going on. And if you need help fixing your credit, maybe you want to invest in distressed real estate, and you want to position yourself away from high interest, adjustable rate credit card debt. Maybe doing a balance transfer, you need a certain credit score to get it. We'd love to help you at GreatCreditFast.com. That's GreatCreditFast.com. Phone number is 561-430-5900. Take a look at this. So I spoke about this last year. Mayor Adams' slow return to office will complicate New York City's economic recovery. Now this came out April 18th, 2022. And this was around a time when people thought that office work and everything was going to start to go back to the city. However, he made a prediction that was quite the opposite of what everyone else was saying. He's saying that at least 20% of all the 5 bureaus' office space will remain empty through 2026. But then something very fascinating came out today from Yahoo News. They are saying that they think that it's actually going to go to 55%. They think that 55% of every single office is going to be empty by the end of the decade as hybrid and remote work push real estate to an inflection point. And we're starting to see this right now with a lot of big corporations closing up office space. And what's ultimately going to happen? If they don't have the direct connection with their customer base or with their employee base, then they're going to start referring customer service, web development. They're going to start referring as much as possible overseas to an affordable location. India, Pakistan, Colombia. You start to, just look at, there's so many talented places that are a hub for smart and ambitious workers. And that's what's ultimately going to happen. They're going to close down office space. They're going to start to outsource more and more and more every quarter from now until 2030. That's what's going to happen, according to this, right? Because what else is going to happen? If they're closing 45%, are they just saying that these 45% of businesses are just basically going to just start working from home and paying $35 to $40 an hour to hire people in America or more? I don't think so. It doesn't seem likely, right? But here's what they're saying right now. In Manhattan, they're saying $12.4 billion per year is costing the city due to remote work. And this is based on today's office vacancy rate. So as vacancy rates continue to rise, what we are going to start to see is that deficit continue to grow, maybe to 20 to 25 to $30 billion per year. So then the big question becomes is how do you fund street services? How do you keep the streets clean? How do you fund the fire department? How do you fund schools? How do you fund the police department? How do you build out the infrastructure to support a city when they're losing money hand over fist with some of the highest taxes in the country, and a lot of these businesses and a lot of successful entrepreneurs are relocating to locations such as Texas and Florida and to Puerto Rico and to other locations, right? I'm going to get to that in a second because what is actually going to happen is going to be shocking. You're going to be completely shocked. PIMCO, they're defaulting on a $1.7 billion mortgage. $1.7 billion mortgage says an office landlord controlled by Pacific Investment Management Company has defaulted on a $1.7 million mortgage note on 7 buildings, a sign of widening pain for the industry as property values fall and rising interest rates squeeze borrowers. The buildings, San Fran, New York, Boston, Jersey City, New Jersey, are owned by Columbia Property Trust, which acquired in 2021 for $3.9 billion. So they bought it for roughly $4 billion, and they're defaulting on a $1.7 billion mortgage. So basically, they put 50% down. And it says that the mortgage is a floating rate debt. Remember that, floating rate debt. which led to rising monthly payments as interest rates soared last year. Now, a lot of people don't know this, but when you buy a house, you have an option to get a 30-year fixed rate mortgage. You have fixed rate debt, but on commercial and office buildings and large-scale multifamily properties, you have adjustable rate debt. It's fixed for a certain period and then it adjusts. And now we're starting to see a wave of pain now that rates are rising. Look, Blackstone, floating rate debt, issued in 2019. 2019, it's a $270 million commercial mortgage-backed security loan backed by 11 properties in Manhattan owned by Blackstone has been sent to special servicing. 637 units in buildings located in Chelsea, Upper East Side, Midtown South. TREP put the portfolio's loan current as of this month. It's on the watch list in November, right? Higher than expected. I mean, we're going to start to see all of this debt continue to rise with a lot of these landlords. As their debt's rising and they're promising to pay their investors, they're not going to be able to do it if they're buying 3 caps and 4 caps, meaning they would pay all cash for the building, which they don't. They put a lot of debt in these buildings. They'd get a 3% return or a 4% return. How do they do that? If insurance and property taxes are going to continue to rise, and we're going to start to see more and more and more people pushed into financial hardship with higher than likely defaults, right? We're going to start to see more defaults. We're going to start to see more of these situations where the companies start blocking withdrawals. KKR blocks a REIT withdrawal in the latest redemption wave, right? This came out about a month, 6 weeks ago, right? Blackstone or BlackRock, $4.2 billion fund, they're halting withdrawals. Top asset managers put new exit restrictions on $9.3 billion UK property fund. And even Starwood Capital Group, right here, they're doing the same thing, notified Security Exchange Commission last month saying they had fulfilled only a portion of the redemption request received in November. But as of total, $20 billion in withdrawals just last quarter. So you're seeing people are just trying to rush out of the floodgates, just trying to get that money out. Because they realize, when am I going to get 3%, 4%, 5%, 6% in this fund? Inflation's 10 or 20, some would say. So I'm putting my money there to lose money. That doesn't make sense. People are going to start, they'll take their money out and they'll put it in treasuries for 5% and get that money every single month and still hold on to their cash. It's going to make more and more sense. People are going to start doing that. But this is fascinating here. We're going to start to see this happen. And, people are they don't realize how big of a deal this is, but this is going to be massive. It's going to change all property values in big cities that are going to go through this change. It says coping with change, early evidence of remote work's impact on urban office neighborhoods and the businesses that once serve office workers may have already emerged during the pandemic. In several studies last year, economists warned of a donut effect or the migration of workers from city cores to suburban areas that are forcing many retail businesses and restaurants to relocate further from the city too. Landlords and building managers have already had to adapt to New York City and LA, where empty office buildings have been converted into apartments and condos. City governments have voiced their concerns over the potential loss of tax revenue from commercial real estate, as New York City's comptroller warned in its budget and forecast last August. Empty offices were an area of concern. They hovered around 20%. Just like Mayor Adams said it was going to in 2026. So we're already there. But when he said this back then, it was a big statement. But we're already there now. So when they're going to start converting all of these empty properties, because when you're buying these deals and you're putting 30-40% down on a $100 million deal, and you start stepping into an era of 55% vacancy, you're in big trouble, right? What they're going to start doing is they're going to start loosening up building codes and zoning codes so that these landlords, these property owners, can do these upgrades. But how many of these property owners can go spend $10 or $20 million on property upgrades to change everything from office into apartments, putting in showers, kitchens, putting in bathrooms, putting in all these upgrades? How many are going to be able to do that? At the same time, many of these buildings, you have to do energy upgrades as well, putting solar, doing all these things. It's going to get very expensive, right? So what we're going to start to see is a lot of landlords that are heavily leveraged stepping into an environment with high interest rates, floating debt, and then high costs for them to try to make money on these buildings. So what I believe is going to happen, there's going to be immense opportunity to go into certain markets and pick up assets to, potentially raise funds to do things in cities because there's just so much debt in these markets where these landlords, they're going to be walking into a wave of problems. This isn't just going to be New York City. It's not just going to be LA. We're going to start to see this in cities throughout America. The obvious ones, of course, Boston, San Fran, Austin. We're going to start to see this happen. But fascinatingly, what will happen as a net result of this, as this continues to grow over the next 7 years, is we're going to start to see increased supply in housing. And they talk about this heavily, saying that we need more housing, affordable housing. Well, if you look at Los Angeles and you look at these expensive markets, and investors are buying these deals at a 4% or 5% cap rate, and it's based on the current level of supply, and then current supply increases by 10, 15, 20, 25%, what ultimately is going to happen to those rents on the existing buildings? They're going to fall. And if rents are going to fall and insurance and the cost of carrying this debt is going to continue to rise, we're going to have a situation where these landlords are going to be operating these buildings at a loss, right? We're witnessing something I think is going to be far greater than 2008. They're saying this right here. 2008 was it was a situation in which we had a lot of bad loans. We had, bad practices, unethical behavior. But this situation is going to restructure cities throughout America, according to them. I mean, this is what they are saying. And we're already starting to see the big dogs start to get smacked around here. But as rates continue to rise and we start to move for additional supply and inventory, this is what I think is going to happen. What do you think? Drop it below, hit the like button, subscribe here. Subscribe also to my second channel. It's an interactive call-in show and a podcast. Have a new guest coming on next week. And if you want to invest in real estate, but you have bad credit, we would love to help fix your credit, build out a game plan for you to position you, because I think there's going to be massive opportunities coming in the next year or so as this whole thing starts to come due. But last thing you want to do as well, because people are like, okay, well, real estate's going to be in trouble. You don't want to hold dollars either, long term. You want to hold dollars now, but in 10 years, do you want to be, have a large position of dollars? Probably not. I think the dollar is going to be stepping into a world of hurt soon. So you want to hold dollars for now, wait until there's opportunity, position yourself, scout out the perfect place for you to, invest, and do that in position and kind of grow and scale wealth while you can. Because we're going to start to see these changes, and you don't want to be stuck holding dollars. You look at currencies all around the world, they're in big trouble. And I don't think the dollar is going to be any different over the long term. Drop below, talk about it, and catch you guys in the next video.